Most Christian couples approaching retirement will quietly lose $100,000 or more, and it's not from a bad market, it's not from fraud, but from 5 planning mistakes they didn't even know that they were making until it's too late. Unfortunately, we see this kind of thing happen over and over again, and the hardest part is that 4 of the 5 have absolutely nothing to do with money. They have to do with what people actually believe. So over the next 15 minutes or so, I'm going to walk you through all 5 of them, including the one that trips up almost every single couple that we encounter and that can permanently reduce what a surviving spouse lives off of after the first spouse passes away. Before I get into it, my name is Snodgrass. I'm a certified financial planning professional, and I run a firm named Mat25 Capital. We're a Christian wealth advisory firm based out of Texas, but we work with clients across the country. We predominantly work with Christian pre-retirees and business owners who want their financial plan to actually reflect what they believe, not just what they've accumulated in terms of assets. Those that don't recognize Mat25, is the firm is named after Matthew 25, which is the parable of the talents. So when we talk about stewardship on this channel, it's not just a marketing angle. It's honestly the entire point of what we do. So here are the 5 mistakes, and I'll walk through each one. Mistake number 1, claiming Social Security based on the break-even age instead of the bigger picture. Number 2, undersaving because God will provide. Number 3, oversaving because fear is louder than faith. Number 4, ignoring the tax bomb sitting inside your 401k. And number 5, treating generosity as the last line item instead of the first. So with that being said, let's get into it. Mistake number 1, the break-even trap, as we're going to call it. This one is the most common, and it costs couples, frankly, the most money over the duration of their lifetimes. A husband comes in, he's 62. He says, I ran the numbers, my break-even age is around 78. I'm not sure I'm going to make it that long, so I'll start claiming Social Security at 62. The math sounds reasonable. Claim early, get a smaller check for more years, wait until 70, get a bigger check for fewer years, somewhere around 78, there's a break-even point, and if you die before it, claiming early wins. At least that's what people think. Here's the problem though. That math treats Social Security like a lottery ticket. You versus the government. And that is the wrong frame of mind. Here's the rule that changes everything. When one spouse passes away, the surviving spouse keeps the larger of the 2 benefits, not both, the larger one. So if the higher earner claims at 62 and takes a permanently reduced benefit, typically around 30% less for life, he's not just reducing his own check, he's permanently reducing what his wife will live on after he's gone. For Christian couples who care about their spouse being provided for, and I assume that's most of the people that are going to be watching this, the break-even calculation is the wrong question. The right question is this: which claiming strategy protects the survivor the most? That usually means the higher earner delays, sometimes till full retirement age, sometimes till 70, and the lower earner can claim earlier if you need the cash flow immediately. That single shift, just changing the question, can be worth $100,000 to $200,000 or more over the course of a marriage. Same couple, same savings, just a different strategy. Mistake number 2, undersaving because you believe God will provide. I'm not questioning God will provide, he always does. This one's harder to talk about because it comes from really a good place. I've had couples sit across from me and say, we haven't saved much, but we know God will provide. And I want to honor that. It's absolutely true. God provides. Scripture is abundantly clear on that, and we can all testify to it. But I also want to point to the parable of talents, which is where the firm gets its name from. 3 servants receive money, 2 invest it and multiply it. The third buries his talent and says, in effect, I knew you were a hard master, so I played it safe and didn't risk anything. The master is not pleased, not even a little bit. Stewardship isn't the absence of planning. Stewardship is planning well with what you've been given. God will provide is sometimes genuine faith, and it's sometimes the thing we say to avoid looking at the numbers and doing what God expects of us. If you're behind on savings, the answer isn't to stop planning. It's to plan more carefully. Catch-up contributions, Roth conversions, spending adjustments, maybe working a couple extra years. Those are the talents being put to work at that time of your life. Mistake number 3, oversaving because fear is louder in your mind than your faith. Now, I don't want to put anyone down. This is the opposite of mistake number 2, and it's just as common, unfortunately. These are the couples who've saved diligently for 30 or 40 years. They have $500,000, $2 million, $3 million, and they're 65 years old, and they're still scared to touch any of it. They keep working when they don't really have to. They give less than they could because they're afraid of running out. They say no to the mission trip, no to helping with grandkids' down payments, no to capital campaigns at church, not because they can't afford it, but because the number in the account still doesn't feel like enough. I want to name what that actually is. It's not prudence, it's fear. And sometimes, not always, but sometimes it's a functional idolatry. The account balance has become the thing we trust more than we trust in God. I'm not saying spend recklessly. I will never say that. I'm just saying know your number. If a 3.5 to 4% withdrawal rate gives you your plan a 95% probability of lasting 30 years or more, then sitting on it and refusing to be generous isn't stewardship. It's hoarding. Retirement isn't about preserving the biggest number. It's about deploying what you were given for your family, for generosity, for yourself in the season that God gave it to you for. The next two are a bit more technical, but stay with me because these are the ones that quietly cost people the most money, and most advisors never explain them clearly. Mistake number 4, the tax bomb in your 401k. For most of the couples that we work with, the biggest single asset they own isn't their house, it's their 401k or IRA. And they've been told for 30 years that these accounts grow tax deferred, which is true. So they think of the full balance as just their money. It's not though, not really. They own whatever's left after taxes. That's right, taxes. If you have $1 million in a traditional IRA and you're in the 24% tax bracket, when you pull it out, that account is really worth $760,000. If you end up in the 32% tax bracket, which is very possible once RMDs or required minimum distributions kick in at 73, especially if you're also drawing Social Security, that same account is worth $680,000. The mistake isn't using traditional accounts. The mistake is having no plan for how you get money out of them. There is a window, a very specific window between when you stop working and when RMDs start at 73, where your income is likely lower, your bracket is likely lower, and you can do Roth conversions at a discount. If you skip that window, the IRS forces your hand later at worse rates. Don't just look at the number, look at the after-tax number and plan for the distribution, not just the accumulation. Mistake number 5, generosity as a last line item. This is the one I care about most. If you take nothing else from this video, take this. Most couples, even Christian couples, treat generosity as the last line item in their retirement plan. They calculate their expenses, subtract Social Security, figure out what they need from savings, and then look at whatever's left and say, okay, we'd like to give some of that, I guess. Proverbs 3, honor the Lord with your wealth, with the first fruits of all your crops. First fruits, not last fruits, not remainders, first. When generosity gets planned first, everything else reorganizes around it. Your spending adjusts, your risk tolerance adjusts, your risk necessity adjusts, your legacy planning adjusts. You stop treating giving as a tax deduction you hope you can afford and start treating it as an obligation and a joyful responsibility you get to meet. Remember, God loves a cheerful giver. And here's the practical side, because I don't want to just make a point. I want to give you something to do. There are tools built specifically for this. Qualified charitable distributions from your IRA, donor advised funds, giving appreciated stock instead of cash. These tools exist, and most Christian retirees don't use them because nobody's shown them how, and maybe because they don't know they even exist. We'll cover those in future videos, but for today, just remember this. Generosity isn't the remainder. Generosity is the plan. Before I wrap up, let me zoom out for 1 minute. If you were paying attention, you noticed something. 4 of those 5 mistakes aren't really financial mistakes. Mistake number 1 is about how you think about your marriage. Mistake number 2 is about whether faith and planning go together or not. Mistake number 3 is about fear versus trust. Mistake number 5 is about what you actually believe your money is there for. Only one of the 5, the tax bomb in the 401k, is purely technical. The other 4 are formation mistakes, and a financial plan that doesn't address them isn't really a plan. It's just math at that point. For the Christian, though, the way you manage money is one of the clearest reflections of what you actually trust. Not what you say you trust, what you actually do trust. And most of us, if we're honest, aren't fully there yet. And that's okay, myself included. The goal isn't just a bigger portfolio. The goal is to finish faithfully and hear, well done, good and faithful servant. So let me give you a quick hypothetical example that pulls this all together. Take two people named David and Sarah. They're both 60. They have about 1.2 million in IRAs and 401ks. David plans to retire at 62 and claim Social Security the same day. He wants to enjoy it while he's healthy. Sarah plans to keep working until she's 65. On that path, here's what happens. David locks in a 30% permanent reduction to his Social Security benefit. Sarah's survivor benefit is permanently reduced by the same percentage. And when they both hit required minimum distributions in their mid-70s, their taxable income spikes, right when IRMAA kicks in and their Medicare premiums go up. Now, imagine one shift, one change. David retires at 62, but doesn't claim Social Security until 67. They use those 5 years to do Roth conversions, shifting $50,000 to $75,000 a year out of the traditional IRAs at lower tax rates. Sarah claims at 67 as well, and their RMDs are smaller. Medicare premiums are lower, and they set up a donor advised fund in year one of retirement to front load their giving. Same couple, same $1.2 million, very different outcome. Probably several $100,000 worth of difference over a 30-year retirement, and in my view, a more faithful plan, frankly. If any of those 5 mistakes feel familiar and you're within 10 years of retirement, I want you to know where your plan actually stands. I built a free 20-question retirement paycheck readiness scorecard. It takes about 2 to 3 minutes, showing exactly where the gaps are in your plan: Social Security timing, tax strategy, income sequencing, and generosity planning. It's at scorecard.mat25capital.com. The link is in the description as well below. So I hope this was helpful. If it is, subscribe. I post every week whenever possible. Next week, I'm going to go deep on Social Security claiming strategy for married couples, the 4-factor framework we use to actually help couples decide when to claim, and why the break-even age is almost never the right answer. Thanks again for watching, and steward well. God bless.